Hello, clients and friends. This is Craig Llewellyn from U.S. Investors International, and it's my pleasure to present our first quarter economic review. We believe an informed client is our best client. As you watch this, please keep in mind it is a review of the months of January through March of 2026 or the first quarter. As 2026 began, equities carried forward the momentum and investor optimism that defined much of 2025. Markets entered the year on solid footing, supported by expectations of interest rate cuts, continued earnings growth, and improving market trends. However, that favorable backdrop began to shift as the quarter progressed, primarily due to geopolitical tensions in the Middle East and evolving expectations around the Federal Reserve's policy path due to inflation. These factors fueled concern and volatility. By the close of the quarter, the market rallied and regained some losses, with the S&P 500 closing at 6,539. However, even with that rally, the S&P 500 still ended down over 4% for the quarter, and the Dow closed at 46,255. And again, despite one of the strongest single-day rallies in March, was also down about 4% for the quarter. For January and February, inflation continued to show some incremental signs of easing. The February Bureau of Labor Statistics data for the year-over-year core price index, less food and energy, rose to expected 2.4%. Since this, we know that inflation actually jumped up over 3 again with the war. We think this is probably short-lived. We just need to get the war out of the way. During the quarter, the U.S. economy remained remarkably resilient. Labor markets continued to show strength, and consumer spending remained healthy. This played into the Fed's decision to hold rates steady. After the quarter closed on April 10th, the March CPI numbers were released, and as expected, the headline CPI rose to 3.3% year over year. This was because the impacts of the Middle Eastern war and surging energy prices were starting to surface, as I was mentioning above. The Federal Reserve is still looking for an inflation rate of 2% or less, and with energy prices rising, this may not be accomplished for some time. Inflation numbers are a subject we need to carefully watch for the next quarter. The federal funds interest rate during the first quarter remained stagnant. At their March Federal Open Market Committee, the Fed adjusted some previous views on the economy, notably a slightly faster pace of growth and higher inflation projections for the remainder of 2026. But so far, they are keeping their rate steady at a range of 3.5 to 3.75%. As financial professionals, we are closely monitoring these interest rates, and we're watching the new Fed chair and the proceedings and what's going on there. So this could be an interesting next month or so. U.S. Treasury rates also experienced some volatility in the first quarter of 2026 and generally rose. This was particularly driven by persistent inflation concerns, continued economic growth, and geopolitical tensions that we are experiencing. As the quarter ended, the 10-year Treasury yield was 4.35%, the 5-year Treasury yield was 3.97%, and the 30-year Treasury yield was 4.91%. Bond behavior continues to hinge on the direction of interest rates. Should the Fed pursue additional rate cuts, existing bonds could appreciate in value. Conversely, expectation of slower easing and persistent inflation pressures could push high yields higher. For investors, bonds continue to play a meaningful role in portfolio diversification. While recent volatility highlights that bonds are not risk-free, especially in a rising yield environment, they can still provide relative stability compared to equities during periods of market stress. However, please remember that while diversification in your portfolio can help you pause your goals or pursue your goals, it does not ensure a profit or guarantee against loss. The big elephant in the room is the price of oil. Due to the conflict in the Middle East, oil prices have risen significantly, and everyone is feeling the squeeze. From personal transportation to the price of moving foods and goods, the consumer price index could continue on an upward turn should oil prices remain elevated. The quarter ended with possible optimism around easing geopolitical tensions, and long-term analysts think that eventually enterprises will correct themselves. The situation in the Middle East will take some time to sort its way out, and we will be keeping a close eye on this matter. Again, as we move further into the second quarter, we're just continuing to see oil go up and down with the tensions in the Middle East. One day they're talking, the next day they're not talking. Until this war gets settled down, we continue to see volatility in oil prices and the markets. Safety still comes at a cost, and sadly, many major banks are still only offering low interest rates to savers. According to Barron's, the average bank money market rate on March 30th, 2026 was 0.51%, and the average 12-month CD rate was 1.85%. For anyone who is interested in exploring sources of better interest rates, please call our office. As the quarter closed, volatility remained prevalent and is likely to be here for a while. While we are still technically in a long-standing bull market, it has had several pullbacks. If things get rough, the news and media could use a lot of terms, and we want to remind you of some of the most common terms used when it comes to volatility. A dip is a short-lived downturn of usually less than 5% from a sustained longer-term uptrend. A correction, like we experienced in April 2025, is usually a 10% drop in the markets from recent highs. We also had a correction here just recently. The markets did hit correction territory, the Dow did back in March. A bear market is a long, sustained decline in the stock market of 20% from its recent high. While not enjoyable, these movements are a regular part of the investment experience. While investors are still optimistic, market volatility is likely to persist. This makes discipline as perspective essential. As you can see from this chart of almost 40 years and many crises, the market does not move in a straight line. In the past 38 years, investors have experienced multiple downturns in equities created by external forces. But one thing that has been constant over this period is that those who invested well and continued a long-term perspective saw greater results. Even the most recent downturn in April of 2025, when markets reacted to uncertainty around tariffs, we experienced a correction, but by the end of 2025, equity investors who demonstrated patience and discipline were rewarded. We think the same thing will happen this year. In summary, uncertainty and volatility remain are likely to be here for a while. However, equities continue to be resilient. This market resilience has been fueled in part by continued growth in artificial intelligence, a resilient labor market, consistently strong corporate earnings, and the Federal Reserve's anticipation that eventually we could see future rate cuts. The Federal Reserve kept interest rates unchanged. They remained at 3.5 to 3.75%. The Fed noted that while they remained stagnant in the first quarter, we could still see rate cuts this year. Inflation increased, but at expected rates. Traditionally viewed as safer haven, bonds experienced some volatility of their own during the first quarter. We will continue to monitor key items that continue to fuel volatility, including oil prices, the path of inflation, interest rates, and geopolitical uncertainty. Focusing on your long-term goals and staying the course of the well-guided plan can help you stay grounded and confident during these times of uncertainty. We're here for you. Please reach out with any questions or concerns. Your financial well-being is always our priority. Once again, thank you for your trust in us. One of our main objectives is to keep our clients informed, and we appreciate you taking the time to watch this update. Thank you for watching this update, and please feel comfortable sharing with anyone else you think can benefit from it. And have a great day.